Hello everybody, Jamie Trull here, your favorite financial literacy coach and CPA. And today we're going to be talking about one of the most common questions that I get asked when it comes to business finances, and that is, does it make sense for me to be an S Corp? We are going to specifically be talking about the differences between an LLC and an S Corp and talk about how in the world you will know if an S Corp truly will save you money. Now, the reason that I really like talking about this is because if you go look out on the interweb anywhere, if you go onto social media, anytime somebody asks a question about how to save money as a business owner, how to save on taxes, the number one response that other business owners will give them typically is, you should become an S Corp. You should become an S Corp. Being an S Corp is amazing. It saved me so much money. And I think that there is a lack of understanding of exactly what an S Corp is and how it saves you money. Okay, so I want to make sure that you go in eyes wide open and don't just believe the hype. Let's make sure that we are fully educated on what all the ins and outs of this are and exactly how it could save you money, and make sure that you have validated before making the decision to become an S Corp that it will be a good idea for you and your specific business. So let's jump on in. Now, first and foremost, we got to clear up one thing, and that's the fact, even though that I talk about becoming an S Corp, what we're really talking about is electing to be taxed as an S Corp, okay? An S Corp is not a legal entity. So typically, you are either an LLC, right? Or you are a C corporation. Either one of those can elect to be taxed as an S Corp. So a sole proprietor can't directly elect that taxation. You would have to become an LLC to be able to do that, okay? So what we're gonna be talking about, we're not gonna talk about C Corps in this video because most of you are probably watching this trying to understand if you should elect to be taxed as an S Corp as an LLC or not. So let's talk about the differences between an LLC and an LLC that elects to be taxed as an S Corp. Now, the key to understanding whether or not an S Corp election is going to save you money is to understand exactly how you as the business owner pay yourself in each scenario, because that is where the tax savings can potentially come in. So let's talk about an LLC without an S election. An LLC without an S election is going to pay taxes and pay themselves out of the profit in their business, okay? So profit being revenue minus expenses, all right? So that is what essentially your paycheck is. You are able to take draws out of that amount. Now, those draws are gonna have two different types of taxes on them. And let me just really quickly clarify the fact that even if you don't take the money out of your business, let's say you leave it in your business bank account, that profit is still taxable to you. It is still passed through to you. So don't think that, okay, if I don't take it out as draws and I just leave it in my business, in my bank account, that I'm not going to be taxed on it. You're always taxed on revenue minus expenses. Okay, so then those owners' draws, that profit, is going to be taxed at two different rates. The first one is your income tax. And that's when we're talking about income tax brackets, right? Remember, it's kind of a graduated scale. The more you make, the higher your taxes generally are going to be. Now, as far as the effective tax rate, and the effective tax rate is not your top end tax rate. We're not talking about those brackets. We're talking about when you average it all together, right? What is your actual income tax rate? Well, effective tax rates can range a ton, but let's put it in the 10 to 25% bucket. That's kind of where most Americans are going to fall. So generally you're going to have your income tax, but you're also going to have your self-employment taxes. That is Social Security and Medicare. And those make up 15.3%, okay? So you're always going to pay 15.3%. And there's no amount of income that is not subject to that. All right, so the interesting thing about income taxes is there's a phase-in, right? The first X amount that you make is not going to have income taxes because of various deductions and things, the standard deduction that you get. Not true when it comes to self-employment taxes. All of your amounts and profits made are going to be subject to this as an LLC without an S Corp election. Now it's time to look at the difference if you do elect to be taxed as an S Corp. Okay, so if you're an S Corp owner, you're going to still have your total profit and you are going to be taxed on all of that, whether you take it out of the business or not, just like if you were an LLC. Okay, so it doesn't matter. Don't think that you can trick the system and keep it in your business. You're going to be taxed on revenue minus expenses, i.e. total profit at the end of the day. However, you're going to be able to take that out in two different types of ways. So an LLC, remember, we could only take owner's draws. Well, when you are an S Corp, you actually take a salary and you're actually putting yourself on payroll as an employee of your business, right? So ultimately what you're saying is part of what I get paid in my business is as an employee of my business. That's a W-2 salary. You're going to have taxes that are going to be withheld on that salary just as you would if you were employing someone that wasn't yourself, right? So you come up with what that reasonable salary is. And then the rest of that money gets put in the bucket that's available for owner's draws that you can take out and pay yourself essentially more like a dividend, let's say. So essentially, as an S Corp owner, you're getting paid for being an employee in your business, reasonable salary, and you're getting paid for being essentially an investor in your business. And that's kind of your owner draws. That is why the taxes that you pay differ depending on whether it's being reasonable salary that you're paying or it's owner's draws. So let's take a look. On your reasonable salary side, the amount that you're paying to yourself as an employee of your business in W-2 wages, okay? You are going to pay income tax, of course, and you're going to pay self-employment tax. Notice this is exactly the same as if you were an LLC. All of your earnings would be taxed with both of these things. Your reasonable salary, your W-2 wages are going to have both of those taxes as well. However, when we come on over to the owner's draws, the only tax you're going to have on owner draws is income tax. There is no self-employment tax on owner's draws. So you're going to save that 15.3% on that portion that is above and beyond your reasonable salary. Okay, so ultimately you get the opportunity to split your profit up into two different buckets and save taxes on one of those buckets. So let's look at a quick example because I think examples really help to drive this home, and let's put some real numbers in here, okay? So let's say you make $100,000 profit, that's after expenses, remember, in your business, but before paying yourself. All right, so that's $100,000 that is profit to you that you can pay out to yourself in owner draws. Now, again, let's say that your effective income tax rate is around 20%. That is very much an estimate. Yours may be close to that or nowhere near that. I don't know your specifics, but we're gonna go with 20% just for the purposes of this discussion. So that's $20,000 in income tax on that $100,000, right? Now we come over to the self-employment tax side, 15.3%, that's $15,300, right? So we can quickly see that in this example, this very simplified example, right? You're gonna have $35,300 in taxes that you would have to pay if you were an LLC. So let's see, would it make more sense maybe to be an S Corp? Let's do this back of the envelope calculation, and then I'm going to tell you why back of the envelope calculations are not my favorite and not specifically reliable. But let me just give you an example for now. So S Corp election example, same 100K profit as before, but now we get to split it into two buckets. Now you are going to have to make sure that you can support your reasonable salary, right? That's really key. A lot of people try to make this as low as possible, which does make sense because that means you're going to pay less in taxes, right? However, you have to be careful and you want to make sure that that amount is defensible, that truly represents what you would pay somebody else to do the work that you do in your business, which is both a science and an art. Now, once you have consulted on that, figured out what your reasonable salary is, let's say you put $60,000 in your reasonable salary bucket, $40,000 in your owner draws bucket, and you're trying to figure out exactly how much taxes you'd have to pay. Well, again, going down the left side, we're going to look at income tax of 20%. That's $12,000, right? Just on your reasonable salary portion. And self-employment tax of 15.3%, which is $9,180 just on that reasonable salary portion. But that's not all the taxes we have to pay. So when we come over to owner draw, we can see that the income tax, again at 20%, is $8,000. So when you add those two income taxes together, they're the same as the income tax we would pay as an LLC. You're not going to save anything in income taxes as an LLC. However, when we compare the self-employment tax, we can see that we actually save quite a bit. $9,180 versus $15,300, right? That's a savings of $6,120 using the back of the envelope method. So you might be looking at this and saying, well, doesn't it make sense to pretty much always be an S Corp? Aren't you always going to save money in taxes? And No, not necessarily. There's a lot of caveats to this. And I am actually not really a fan of this back of the envelope calculation from the standpoint of actually making the decision and being fully informed on becoming an S Corp. And there are a lot of accountants out there and lawyers who do the calculation still like this. And it's really not giving their clients a full picture of really what the costs and benefits are. And oh, by the way, this calculation doesn't take a lot of different things that impact your taxes into account that could impact the determination of whether you would actually save money or not. So a few of those things that a calculation like this does not take into account. Well, it doesn't take into account the qualified business income deduction. And I am sure as heck not going to be doing a full tutorial on that here because it is confusing. But it is a deduction that was introduced back in 2018 with the passage of the Tax Cuts and Jobs Act. So what that did at that time is it introduced this crazy calculation related to qualified business income that has all these different phase outs and all of these different considerations to basically be able to give small business owners the opportunity to save more in taxes. But it's super, super complicated, okay? And it also could potentially make it where an S Corp isn't as beneficial as it might otherwise look on paper, okay? Now, when accountants run this, you want to make sure that they are using that information. You want to ask them whether their assessment is more of a back of the envelope or whether it includes the qualified business income deduction. The other consideration that can really impact whether an S Corp makes sense for you is your retirement contributions. If you have a retirement account that you are contributing to, it can impact what your total allowable contributions are based on the type of plan that you have. And that can also impact whether or not it makes sense to be an S Corp. And there are lots of other things related to your personal tax situation and any other income you might make and any other deductions you might have that could influence whether an S Corp is right for you. And oh, by the way, sometimes we forget to talk about the fact that self-employment tax actually does phase out after a period of time, okay? Social Security is going to phase out. So it's not like you're gonna pay it forever and ever and ever. If you make over a particular amount and that amount changes every year, it's going to phase out. So that's another reason that the back of the envelope calculations just are not accurate. And the other thing I always want to tell business owners when they are told that S Corp is going to be the thing that will save them all the money, right, is even if it's true, which it very well could be. I'm not saying S Corp can't save money. It definitely can in the right situation, right? But you also have to think about the trade-offs, and those trade-offs are typically going to be in the areas of compliance. So now if you are an S Corp versus when you were just an LLC, now you have to run payroll for yourself, right? And withhold taxes. Now you have an extra tax filing that you're going to have to do. Now you're going to have to figure out what your reasonable compensation is, and you're going to have to be able to defend that, okay, to the IRS if you are audited. So you're going to have actual documentation of how you came up with a reasonable salary because the IRS is always looking for people setting their reasonable salaries far too low. And let me just tell you, PSA here, don't ever set your reasonable salary to 0 because that is a massive audit red flag, okay? A lot of the people out there who talk about saving tens of thousands of dollars as an S Corp, it might be because they're not actually paying themselves a reasonable salary at all. Okay, so yeah, they're probably saving a ton on self-employment tax, but it's also illegal. Now, I know if you're watching this channel, it's because you want to do things right. Okay, so you want to do things right. So I do recommend that at a certain point, probably around the time that you're getting to $60,000, $70,000, $80,000 in profit in your business, it's a really good time to start looking at this more in depth and deciding whether or not you want to make that tax election. Now, I do recommend doing the election by March 15th each year. So if you wanted to do this for 2023, you probably want to be looking at it now. Okay? You probably want to be deciding if you're going to make this change because once you make that change, now we're talking about getting set up on payroll and all those other compliance things that you need to do. Now, if this sounds overwhelming, don't run away because it definitely can be worth it for the right person. But one of the things I'll caution you against is taking the advice of someone who doesn't know your specific situation and isn't taking all of these things into account when they are advising you. And sometimes accountants, I love my fellow accountants, not to say anything bad about them, but sometimes accountants might advise you to do this sooner rather than later, in part because they have a little bit to be gained by you being an S Corp in terms of additional tax filing fees and running payroll for you and doing reasonable compensation reviews, right? All of those things cost money. So typically an accountant might have something to gain by recommending S Corp status to you. So make sure that you are informed. I'm a really big fan of business owners empowering themselves, and that's why I have an education-based company and not a service-based company. So because I kept getting asked this question, I kept getting people asking me specifically to do an analysis of their business to determine if S Corp is right for them, I created a product, okay, where you can empower yourself with all the knowledge that you need about S Corps, right? So we're gonna go even deeper here around the different compliance requirements, what you need to know in a crash course all about it. But what's really great about this new S Corp Toolbox that I am just coming out with right now is the fact that it's also going to give you all the resources that you need to determine if it's right for you, to do an accurate calculation that takes into account all of these things that we've talked about today and determine what your tax savings really could be. It'll help you figure out what your reasonable compensation should be so that you can accurately do these calculations as well. And then we're gonna give you a checklist of all the things that you need to make sure you have in order, like payroll, workers' comp, all of the potential things for you to think about once you have elected S Corp. And we're gonna show you how to do the election yourself for free, okay? So all of that comes in this S Corp Toolbox. It's all the tools that you need to learn about S Corps, decide if they're right for you, and elect to be taxed as an S Corp, and then be able to be compliant with all the rules and regulations and make Uncle Sam happy. So if you're nodding your head right now saying, yes, this sounds amazing, and I would absolutely love this for a fraction of the price of what you would pay a CPA to do this analysis for you, then go check out jamietrull.com/S Corp Toolbox. I really want you to take a look at all the amazing things that you are going to be able to get just by jumping in and take advantage of our special offers. I hope you found this helpful, and I'll see you next time.